I extend a warm welcome to all of you on Lipper Fund Awards 2019. Okay, so we'll get started with a quick overview of Fund Awards methodology. So to start with, the first step is to first arrive at the qualified funds for Fund Awards. So to do that, what we look at is we first consider all the funds that are registered for sale in India as a region. Thereafter, we look at the funds that has at least 3 years of performance history. Thereafter, we remove funds, the funds that are having AUM less than 35 crores, that gets eliminated, wiped out from the evaluation. And thereafter, the fund classification, the fund categories that are left with at least 5 funds meeting this criteria are considered for fund awards. And the broad categories that are covered for fund awards are equity, bond, mixed asset, and alternate. Moving on, talking about the types of awards that we have 3 broad categories of awards. The first is the classification award. So the local terminology that we have for classification is generally category. So this is a category level award. Here we are giving out awards to 8 categories. The second we have is asset group awards. In this we have 3 main categories: equity, bond, and mixed asset. And the last one is overall group award. So let's have a little closer look at the classification or the category level awards, how we go about arriving at the winners. So we have our proprietary risk adjusted returns, which is called Lipper consistent return. We compute that for all the funds that are eligible in their respective categories for the period of 3 years, 5 years, and 10 years. And what we do is, once we have the Lipper consistent return, in a given category, we pick up the fund which has got the highest score. So this time around, we are giving out awards to 24 funds. And these 24 funds comes from 9 fund companies. Moving on, so let's look at the asset group awards, right? So here, now we are considering fund company, not the individual fund. It's fund company in total. So if one fund company has to qualify for asset group award, they need to have at least 3 funds making representation in the respective asset group, right? And here, in the asset group, it's only 3-year period performance is being looked at. Subsequently, what we do is we actually take the average of all the funds for a given fund company in the respective asset group, and then pick up the best performer there in that respective category. Looking at the overall group awards, it's just level next to the asset group awards. Again, we are looking at the fund companies in total. The only difference here is that the fund company needs to have representation across all asset groups. Only then they qualify for an overall group award. And eventually, we take the average score of all the represented funds for all the fund companies, and the fund companies which has the best score gets the award from us. Again, we have the same caveat. If at least 3 fund companies are meeting the stated criteria, only then we give out this award. So this is the brief, little overview of the fund award methodology. From here, now we will get into the action. We will have the award ceremony.
So, are we all ready to receive the awards? It is my pleasure indeed to call upon Sarah, Market Leader, Customer Success, South Asia Definitive, and Arun Prasad, Proposition Sales Leader, South Asia Definitive, to come on stage and join me here and present the first set of awards in the Fund Classification Awards segment. First winner of the evening is CANARA ROBECO Asset Management. next winner is Franklin Templeton Asset Management India. And the winning funds are Franklin India Dynamic Accrual Fund Growth Plan in the Bond INR category as the best performing fund over 3 years, and Franklin India Short-Term Income Plan Retail Plan Growth Option also in the Bond INR category for the best performance over 10 years. Our next winner in the category of fund classification is HDFC Asset Management. The winning fund is HDFC Children's Gift Fund Regular Plan, which bags the award in the Mixed Asset INR Balance category for best performing fund over 3, 5, and 10 years. The next winner in this category is ICICI Prudential All Seasons Bond Fund Retail Cumulative, which wins the Bond INR category as the best performing fund over 5 years. ICICI Prudential Banking and Financial Service Fund Growth, which bags the award in the Equity Sector Financial category as the best performing fund over 5 and 10 years. And ICICI Prudential Equity and Debt Fund Growth, that wins in the Mixed Asset INR Aggressive category as the best performing fund over 10 years. Let's now call upon stage Anirudh Chatterjee, Market Leader, Account Management South Asia Refinitiv, and Anupam Bagri, Market Leader, Customer Connect South Asia Refinitiv, to join me on stage for the next set of awards. Our winner for this category is KOTAK Mahindra Asset Management, and the winning fund is KOTAK Equity Arbitrage Fund Regular Plan Growth in the Relative Value Arbitrage category as the best performing fund over 5 and 10 years. Our next winner is Mirai Asset Global Investments India. The winning funds are Mirai Asset Tax Saver Fund Regular Plan Growth in the Equity India category as the best performing fund over 3 years, and Mirai Asset Emerging Blue Chip Fund Regular Plan Growth also in the Equity India category as the best performing fund over 5 years. The next winner is Reliance NIPPON Life Asset Management. And the winning funds are Reliance Arbitrage Fund Growth Plan Growth in the Relative Value Arbitrage category as best performing fund over 3 years, and Reliance Gilt Security Fund Growth Plan Growth Option in the Bond INR Government category as the best performing fund over 5 years. Our next winner is Tata Asset Management, and the winning fund is Tata Retirement Savings Fund Moderate Plan Regular Plan Growth in the Mixed Asset INR Aggressive category as the best performing fund over 3 and 5 years. A huge round of applause for Tata Asset Management. The winning funds are SBI Magnum Constant Maturity Fund Regular Plan Growth in the Bond INR Government category as the best performing fund over 3 and 10 years, SBI Banking and Financial Service Fund Regular Plan Growth in the Equity Sector Financials category as best performing fund over 3 years, and SBI Magnum Children's Benefit Fund Regular Plan Growth, which bags award in the Mixed Asset INR Conservative category as best performing fund over 3, 5 and 10 years. With this, we come to an end to Fund Classification Awards, and I would now like to bring on stage Sriram Ramnarayan, Head of Market Development South Asia Refinitiv, and Stewart Ueno, Director Regional Marketing Asia Pacific Refinitiv, to present the next set of awards, which are the Asset Class Group Awards. Let's welcome them on stage, please. Our first winner in this segment is Franklin Templeton Investments for Best Performance in the Bond Asset Group. Our next winner is Virai Asset for Best Performance in the Equity Asset Group. And our final winner in this segment is ICICI Prudential. Let me now invite on stage Pradeep Menon, Managing Director, Investing and Advisory Refinitiv, and Patrick Donaldson, Head of Market Development, Wealth, Asia Pacific Refinitiv, to please come on stage. And this award for the best overall group performance goes to ICICI Prudential.
Let's get started with our discussions on the panel. So Pradeep, maybe I can kind of start with you, right? There's a very interesting fact that's coming out from all the discussions which is happening. CFA Institute, they have done a survey of about 500 sell-side and buy-side professionals, and they kind of highlighted that there is a huge worry or huge gap in terms of the quality and quantity of the research coverage. So in your conversations with the global buy sides that you go and visit, I know very often, is that something which is being very apparent?
Absolutely. You hit a good point. I'd love to hear from the other panelists on this. What's a clear trend is the number of companies being covered by the sell side relative to the broker, so to speak, has shrunk quite significantly. On one end, we had about 80 brokers covering a stock like Vodafone. I don't think that was really necessary to do that. But the unknown or the unintended mistake or unintended consequence of this was that a lot of the small caps or mid caps stopped getting any coverage here. We have a lot of the buy side now stepping up, but you're absolutely spot on.
Absolutely.
There's been a hit in terms of coverage from the sell side.
So if I may, ask Nilesh, you to kind of take the lead here, right? So our observation, if my data is correct, so roughly considering the large cap and the mid cap categories, so we roughly have about 70 odd schemes right now active out in the industry. And if you look at the total number of companies that we cover in all these schemes, that would be upward of 300. Now, do we really have enough coverage for these 300 companies?
Yeah, I mean, your observation is right. I mean, if you, first of all, if you slice the market, I mean, the top company is a $100 billion market cap, and the mid cap definition is now very well defined. The 100th company is where the large cap stops, which is about 4 billion. And 4 to 1 billion is the bucket of mid cap, which is about another 150 companies. So actually, we're talking of a universe of 250, 300 companies. I think there are two sources of sort of information. One is what we do in-house, which is the primary research, and secondary research, which we get from external sources. Over time, I think it's been quite evolved. We are sector-wise analysts from the secondary side. So the quality of information and the quality of the analysis has significantly improved over the last couple of decades. So to that extent, it's not a challenge per se with the dissemination of information to track set of say about 300 odd companies, which is where it is meaningful.
All right, thank you. And so what we are asking you that, would you really want your fund manager to be socially responsible? So yeah, let's start the polling right now. Okay, so I guess Pradeep, you'll be very happy to see the outcome, right? So most of the people I'm not sure what is the population of millennial we have in the room, but they actually want them to be more socially responsible, right? So before we go to them, that's there's the same thing that you hear from the other markets as well.
I wouldn't say all the other markets. I have been to markets where they say, get out of here, it's all about return, and
Right.
return, and return only. And I respect that, that's fine. But on the flip side, there are markets, Scandinavia, Canada, Australia. If you don't have a ESG or environment and social and governance policy, you're dead meat. It is part of the portfolio construction technique. It's just inherent there. You ask a millennial that there are two funds. Fund 1 that gives you a 5% return, and Fund 2 that gives you a 4.75% return, but is investing in ethical companies and socially responsible companies. Almost to a T, those millennials opted for the 4.75% return. Now, my hypothesis is that millennial doesn't have any money to invest, so that it doesn't really matter where they're going to vote for. But nonetheless, it's a trend that's there and it's showing up and something for us to keep aware of.
I'm not sure 2024 whether we are going to be at 5 trillion, 4 trillion, 3.5 trillion, but certainly there is going to be a momentum in the economy. What you think, and if each of you can give us two top drivers that you think is going to really drive the economy in the next coming years?
Unless we have a large savings, unless our savings in the country increases, I think investments will be difficult to come by, and if investments come up without having adequate savings, it will have an impact on on your currency. So I think one key driver would be to increase the savings in the country. So that's what I can think of on the macroeconomy side. That will be essential, according to me, if you need to have a sustainable growth for a long period of time.
Right. Okay. Naren?
Actually, the way we look at it, for growth, you need low land prices, low interest rates, and you need low labor. I think labor is very reasonably valued. That's why you have 4,500 people in Bangalore. And it's only land and interest rates, and it has to be easy to buy land, and it should be cheap. I find it strange that in a poor country like India, you have $2 million houses, so many $2 million houses in Bombay. So I would say it's just basically, and you have to improve ease of doing business. I think the government is working on all this,
okay,
but they have to do it much faster, and they have to work much harder to bring down land prices. Because the moment real estate becomes cheap, I think a lot of construction activity will create big growth. That's my view.
Thank you very much. Thanks for spending your time. I know all of you are extremely busy, but you give us the time, so we really appreciate that. Thanks very much for being such a lovely audience. I hope that you kind of enjoy the discussion that we had.
So it's been a really interesting evening, and we've heard some of the insights from the earlier panelists, the earlier speakers, and now we really come to the next very interesting theme. What is technology and digitization really doing to this business of wealth management, asset management, in an economy as vibrant and as exciting as India is? So why don't you start this off, Praveen, in case you have any insights on the answers we just got, or otherwise just tell us how you see the business of wealth management from your eye as you're getting more and more Indians to transact on Paytm.
So I think I relate a bit with the last question, which is, would you want people to invest via technology company? My answer definitely would be yes, because that is what I'm representing right now. But just few facts. Just before we go to mutual funds, okay, I was just talking to everyone out on the panel in terms of, we have a product called Paytm Gold, in which Indians are today saving gold digitally. Okay, they don't see the gold. And the number of people today who are on that product is more than 20 million. That is more than the number of mutual fund investors today that we have. So just imagine this, right? Indians are buying gold, and gold that they can't see, but it's in their wallet, safe, secure, they can sell whenever they want it. So things are changing very, very fast. Now coming back to mutual funds and our product, Paytm Money, we launched about 9 months back. We have around 3 million users on the platform, and these are acquired all organically, not a single dollar spent on user acquisition. So the kind of demand that we are filling in for is a lot of first-time investors who always heard about mutual funds, but never had a chance or opportunity to come to a platform or come to a distributor or advisor and get invested into. The reason being, this is the real India. This is the people who are coming from beyond 30 cities, tier 3, tier 4, and investing and starting as little as 100 rupees.
Very, very interesting. So the outcome is, just sums up the beauty of the conundrum, right? Because most people don't really want Google to take their wealth management decisions, yet most people are not too happy with their relationship manager either.
Yeah. No, I think it doesn't surprise me. It's the classic David versus Goliath battle. So, the audience always likes the challenger, right? And technology today is perceived as a challenger, but I have a bit of a perspective around banks and how banks are thinking fundamentally. Today, very clearly, I don't think you can actually segment the marketplace saying there are banks and then there are technology companies. Banks today are fundamentally technology companies. Sure. So banks are basically technology companies with a banking license, if I have to put it that way, simplistically. Now, I think this just tells us the opportunity that exists in correcting this gap in service delivery. What this short survey in this closed room brings out is that even today, there is a big gap between what customers, and each one of us is a customer first, believes he or she should get when he's buying a product, let's say a mutual fund, to what he actually experiences. And I think technology will be a massive game changer in this journey.
As you're looking at this market from a global standpoint, what thoughts come to mind?
So I think the first thing is that fundamentally, globally, India is very similar to the rest of the world in terms of the objectives of the wealth management industry. Individual investors just simply want to make the right decision. They want to buy the right investment, to fit in with their longer-term financial plan. The wealth management advisors want to offer the right advice, and that's no different wherever you are. I guess the difference in India is the scale, partially. There are always sort of domestic differences from one country to the next. They're similar, but obviously each country is slightly different. But if you go to those three questions, those actually, although they might appear relatively high level, they do strike at the heart of wealth management. So the first one is, you can't answer the question about which asset class to buy unless you understand the circumstances of the individual person. And the second one, it should be point one in terms of specific and relevant advice because everybody's circumstances are different. And the third question about technology companies is an issue around trust. Wealth managers are not, I think, trusted to the extent that they should be, and this is a global challenge because I don't think the interests of the wealth managers are necessarily aligned with the interests of their clients. And it's a huge challenge, right? Because it's a very personal thing, investing. It's personal because it's the money you've earned or potentially inherited, and it's, you're trying to predict the future in a way, and you need to believe it's going to work to some extent to actually get into it. But the state's not going to look after all of us. We need to invest, and we need to find people that we can feel confident with to help us achieve that.
Sang, a simple question. Is a computer program my best bet at knowing which fund will do well? Because at the end of the day, if it is all about data collection, comparing ratios, looking at portfolio changes, all of it, at the click of a button can be pulled in. So should I trust, at the end of the day, a computer, unbiased computer, more than a human advisor? That's, I think, the crux of this debate right now.
I think this is a tricky question. First of all, I think in terms of computer, they are good at learning from the experience, from the data. So in terms of generalization, they're good. So what we can see the trend in terms of robo-advisory is they are more involved in more passive investing, involving usually low-cost fund that is linked with preset mix of instruments, while they may not be really aiming at beating the markets. Rather, they will try to keep up with the overall market gain in time. Whereas when you have a really complex financial situation or requirements, it's quite difficult for a computer to be able to solve your problem. In conclusion, I think to be able to handle more complex financial situation, it's still best to have a people advisor.
Thank you, panelists, for your thoughts. Well, with that, we'd like to draw this session to a close. Once again, I thank all my panelists for sharing the time. Thank you.